Most property deals actually fell. Not always in dramatic ways where someone loses everything overnight, but in quieter ways that investors only realise years later. The returns never materialise the way they expected, management becomes more complicated than anticipated, or the numbers simply stop working when market conditions change. And the reason this happens is surprisingly simple. Most investors are analysing property deals in a way that is far too optimistic. So, in this video, I want to explain why that happens, what many investors miss when they evaluate property opportunities, and why I eventually developed a structured way of analysing deals before committing capital. So, after buying my first property, I started paying far closer attention to how property deals were being presented online and within investor circles. And something quickly became clear. Most deals were being presented using extremely simple numbers: the purchase price, the rental income, and the projected yield. On the surface, the deals looked attractive and easy to understand, but when I started examining them more closely, I realised that many of the assumptions behind those numbers were extremely optimistic. Maintenance costs were often underestimated, void periods were ignored completely, financing assumptions were based on ideal scenarios rather than realistic ones, and operational complexity was rarely discussed at all. The deal might look appealing on a spreadsheet, but the spreadsheet was only showing a very small part of the reality. Spreadsheets can be extremely useful tools, of course, but they also have a limitation that many investors overlook. A spreadsheet will only be as accurate as the assumptions behind it, really. So, for example, if the rental income is slightly optimistic, the yield looks better than it really is. If the costs are underestimated, the profitability appears stronger than it will be in practice. And if financing assumptions change, the entire deal can behave very differently. I've seen many deals that look profitable when interest rates are low, but become extremely tight when financing costs increase. The spreadsheet itself hasn't changed, but the reality of the deal has. And this is one of the biggest reasons investors can feel confident about a deal at the beginning, only to realise later that the margins were far thinner than they initially believed. Another common issue in property investing is what I call the cash flow illusion. So many deals are presented based on best case assumptions, but in reality, the rent is assumed, it's assumed to be stable. Their tenants are assumed to remain long term. Repairs and maintenance are assumed to be minimal, and void periods are often barely accounted for. But property rarely behaves perfectly. Unexpected repairs happen, tenants move out, interest rates change, compliance requirements evolve, and each of these gradually reduces the profitability of a deal that once looked extremely attractive. This doesn't mean property investing doesn't work. It simply means the assumptions need to be realistic. One of the most underestimated aspects of property investing is operational complexity. Some strategies look extremely profitable on paper, but require far more management than investors initially expect. HMOs are a really good example of this. They can generate strong rental income, but they also involve licensing requirements, safety, compliance, multiple tenants, ongoing management coordination, and none of those factors appear clearly in a spreadsheet, but they can significantly affect the experience and cost of owning that property. The more complex the operation, the more disciplined the investor needs to be. Another issue I see frequently is that many deals are not properly stress tested. Investors often calculate returns based on the current mortgage rate without asking a very simple question. What happens if that interest rate increases? Or what happens if refinancing becomes more difficult in the future? Property is a long-term investment, so because of that, financing risk needs to be considered very carefully. A deal that only works in perfect conditions is not necessarily a strong investment. A strong investment is one that remains resilient even when conditions change. Another area that investors often overlook is the exit strategy. Many people spend a lot of time analysing how to buy a property, but very little time thinking about who will eventually buy it from them. If the property is extremely specialised, then the potential buyer pool may be much smaller than expected. If regulations change, for example, then certain property types may become less attractive to future buyers. And if the property is heavily leveraged, refinancing options may become limited. So, understanding the exit from the beginning can prevent many issues later. So, for me, after several years working across different areas of property, I realised that many investors were evaluating deals through a very narrow lens. They were focusing heavily on projected returns, but not enough on the broader structure of the investment. That observation eventually led me to develop the core framework, which I now use to assess property deals before capital is committed. Core stands for 4 key areas. Cash flow quality, so analysing whether the financial projections remain strong under realistic assumptions. Operational control, so how complex the property will need to be managed. And risk management, so evaluating the leverage levels, the financial exposures, financial resilience, and of course, the exit, assessing how you're going to sell the property in the future, or if you're going to sell it at all, what is the plan for the next step? When a deal is analysed across all 4 of these areas, the picture becomes much clearer. On this channel, I'll be using this framework to break down property deals and explain how they behave beyond the initial spreadsheet calculation. We'll look at real property scenarios, deal analysis examples, investor mistakes, and the operational realities behind different strategies. The goal is not to discourage people from investing in property. The goal is to encourage better decisions before capital is committed. Because the quality of the deals you choose will ultimately determine the strength of your portfolio. If you found this video useful, feel free to subscribe to the channel, because in the next video, I'm going to show you exactly how to analyse a property deal step by step using our core framework. And if you're currently evaluating property opportunities and want a structured second opinion before committing capital, you can apply for a core deal audit where I review potential deals through this framework. Thank you so much for watching, and I'll see you again in the next video.